Do you ever wonder why some companies get so big and powerful? Have you heard people say that without government control, businesses will become monopolies? What if I told you there is a new player in the game that can change all this? Welcome to Crypto Tree TV. Today, we'll explore the truth about monopolies and how Bitcoin is changing the game. Ready to learn the secret knowledge of monopolies and Bitcoin? Let's get started! So, do free markets really lead to monopolies? Many people believe that if the government doesn't control businesses, one big company will always win and take over. This is a common fear. But is it true? George Orwell once said, "The trouble with competitions is that somebody wins them." This makes people think that in a free market, one company will always dominate. But this isn't the whole story. Let's look at history. Gabriel Kolko, a historian, studied big businesses in the past. He found that many large companies tried to control markets, but often failed. These big businesses thought they could make more money by forming monopolies. However, smaller, more efficient companies often beat them. For example, in the late 1800s, many businessmen tried to create large conglomerates and cartels. They believed bigger was better. But in reality, these big businesses often made less profit than smaller ones. They couldn't control prices and kept losing market share. This shows that in a free market, competition helps keep businesses in check. Big companies cannot just take over because they have to compete with smaller, more efficient firms. So, the idea that free markets always create monopolies is more myth than reality. If big companies often fail to create monopolies, what does history show us? Let's dive into some real examples. Gabriel Kolko, a historian, found that in the late 1800s and early 1900s, many large businesses tried to form monopolies. They believed bigger companies could control prices and dominate markets. But Kolko discovered the opposite. Take the steel industry, for example. Big companies like US Steel tried to control the market. However, they faced tough competition from smaller steel mills. These smaller companies were more efficient and could produce steel at lower costs. As a result, US Steel couldn't keep prices high and started losing market share. Another example is the oil industry. Standard Oil, led by Rockefeller, is often cited as a monopoly. However, small independent oil companies frequently cut prices to compete with Standard Oil. This competition kept the oil market dynamic and prevented complete control by any one company. Kolko's research shows that free markets naturally limit monopolies because smaller, more efficient companies can always enter the market and compete. So, history teaches us that monopolies are not as inevitable as some might think. Competition plays a crucial role in keeping markets fair and balanced. How does the government impact monopolies? Can it actually make things worse? Many believe that government must step in to prevent monopolies. But Gabriel Kolko found something surprising. He argued that government intervention often helps monopolies instead of stopping them. For instance, Kolko showed that regulatory agencies like the Interstate Commerce Commission (ICC) were formed to control monopolies. But in reality, these agencies often protected big businesses. Large companies that couldn't compete efficiently used the government to limit competition. A clear example is the ICC, which was supposed to regulate railroads. Instead, it helped big railroad companies by setting high barriers for new competitors. This made it hard for smaller companies to enter the market and challenge the established ones. Another example is the Civil Aeronautics Board, CAB, which regulated the airline industry. The CAB restricted new airlines from starting, helping existing airlines maintain higher prices and less competition. Kolko's research shows that government intervention can sometimes protect inefficient monopolies rather than encourage fair competition. What kinds of monopolies exist and how do they work? And how does Bitcoin change the game of market competition? Let's find out. There are three main types of monopolies: natural monopolies, artificial monopolies, and state monopolies. Natural monopoly. This happens when one company can produce goods more efficiently than anyone else, usually because of high initial costs. For example, a single steel mill can be more efficient than many smaller ones. But even natural monopolies cannot raise prices too high because competitors will enter the market if prices go up too much. Bitcoin prevents natural monopolies. In traditional markets, big companies can dominate because they are more efficient. But Bitcoin's technology, based on blockchain, ensures that no single entity can control the network. Miners and nodes worldwide work together, keeping the system decentralized. Artificial monopoly. These are created by businesses trying to control the market. A good example is US Steel, which was formed by buying up many smaller firms. However, artificial monopolies often struggle because smaller, more efficient competitors can still undercut them on price. Bitcoin stops artificial monopolies. In industries like steel or oil, big companies try to control prices. Bitcoin's open source nature allows anyone to participate in mining and transactions, making it hard for any one group to dominate. Even if a mining pool gets big, the network adjusts to maintain fairness. State monopoly. These are created and maintained by the government. The post office is a classic example. Private companies cannot compete in delivering first-class mail because it's illegal. State monopolies are often the most enduring because they are protected by laws. Bitcoin challenges state monopolies. Governments control money supply and can create monopolies through regulations. Bitcoin operates independently of governments, providing a global, decentralized currency. This means people can use Bitcoin without relying on traditional financial systems controlled by states. In short, a natural monopoly cannot easily control prices due to potential competition. Artificial monopolies face the challenge of smaller competitors. State monopolies, protected by law, can prevent competition entirely. And Bitcoin's design ensures a competitive, fair market by being decentralized and open to all. It changes the game by preventing any single entity from gaining too much control. We have learned a lot today about monopolies and how Bitcoin changes the game. I hope you found it helpful. You don't need to subscribe or like this video, but if you want to understand Bitcoin better, my videos can help. I read every comment, so feel free to share your thoughts and questions. Here on Crypto Tree TV, I share the secret knowledge that the Matrix doesn't tell you. I want to help you understand Bitcoin and how it can make our world better. Because I believe everyone deserves to know the truth about money and freedom. Let's escape the Matrix together!